Hello, everyone, and welcome to me podcast. I'm Rachel Thornton, a website user experience consultant, and today I'm flying solo for an in-depth deep dive into a fantastic blog I recently came across. In-Depth Guide to Internal Rate of Return, IRR, in Commercial Real Estate, by Cara Conde, who is known as Indianapolis's premier commercial real estate agent. If you're a real estate investor, or even someone curious about how to evaluate investments, this episode is for you. We're going to unpack IRR, what it is, how it works, its pros and cons, and how Cara Conde uses it to help her clients make smarter decisions in Indianapolis's competitive market. Plus, I'll sprinkle in some UX insights on how this blog is designed to be user-friendly. So let's dive in. First, let's start with the basics. What is IRR, or Internal Rate of Return? According to the blog, IRR is the discount rate that makes the net present value, or NPV, of all cash flows from an investment equal to zero. In simpler terms, it's the annualized rate of return you can expect from a commercial real estate investment, taking into account the time value of money. Now, if you're wondering why that matters, the time value of money is this idea that $1 today is worth more than $1 tomorrow, because you can invest it and earn a return. IRR captures that beautifully, which is why it's such a critical metric for real estate investors. The blog explains that IRR is different from other metrics like ROI or cap rate because it considers the timing of cash flows. For example, ROI just looks at total profit without factoring in when you get that money, while IRR gives you a time-weighted, annualized return. That's super helpful when you're comparing, say, a stabilized office building with steady rental income to a value-add industrial property with higher risks but bigger potential returns. Now, let's talk about how IRR works in the real world of commercial real estate, which the blog breaks down really well. It's all about three key components: your initial investment, like the purchase price and closing costs, your cash flows, which include rental income minus expenses, and the holding period, or how long you own the property. Cara Conde gives a great example in the blog. Imagine a $1 million office building in downtown Indianapolis. You expect $100,000 in annual net cash flow for 5 years, and then you sell the property for $1.5 million. IRR helps you figure out the rate that balances all those cash flows with your initial investment. In this case, the blog calculates an IRR of about 15.24%. Pretty neat, right? But here's where Cara's expertise shines. As the best Indianapolis commercial real estate agent, she ensures those cash flow projections are accurate by leveraging her deep knowledge of the local market. Whether it's negotiating better lease terms or spotting undervalued properties, she makes sure her clients' IRR calculations are grounded in reality. Let's move on to calculating IRR, because I know some of you are thinking, okay, Rachel, this sounds great, but how do I actually figure out the IRR for my investment? The blog does a fantastic job walking us through this. Mathematically, IRR is the rate where the NPV of all cash flows equals zero. You can solve it manually using a trial and error method, but honestly, that's pretty tedious, especially if your cash flows are irregular. Instead, the blog recommends using Excel's IRR function, and they even provide a step-by-step example using that same $1 million office building scenario. You just input your cash flows. Negative $1 million for the initial investment, then $100,000 each year for 5 years, and $1.6 million in year 5 when you sell. And Excel spits out that 15.24% IRR. Super straightforward. The blog also mentions that irregular cash flows can complicate things, sometimes leading to multiple IRRs, which can be confusing. That's another area where Cara Conde adds value. She collaborates with financial experts to make sure her clients' calculations are spot on, especially in a market like Indianapolis where tenant demand and market trends can shift. So how do you actually use IRR in commercial real estate? The blog outlines several applications that I found really practical. First, it helps you assess investment viability. If your IRR is higher than your minimum required return, often called your hurdle rate, then the investment might be worth pursuing. For example, if your hurdle rate is 15% and the property's IRR is 18%, that's a green light. IRR also lets you compare different opportunities, even if they have different cash flow patterns or holding periods. And it's great for scenario analysis. Think best case, worst case, and expected outcomes based on market conditions. Cara Conde shares a case study in the blog that I loved. She advised a client on a retail property in Fishers, Indianapolis. By negotiating a higher lease rate and securing a long-term tenant, She boosted the property's IRR from 12% to 16%, which justified holding onto the property longer. That's the kind of real-world impact a skilled agent can have. Now let's talk about why IRR is so powerful, because the blog lists some clear advantages. For one, it's comprehensive. It accounts for all cash flows and the time value of money, giving you a holistic view of profitability. It's also great for comparisons, letting you evaluate different property types side by side, like a retail center versus an industrial warehouse. And it annualizes your returns, which makes long-term planning a lot easier. Cara uses IRR to help her clients prioritize high-return investments in Indianapolis, and you can really see how it guides her decision-making process. But, and this is a big but, IRR isn't perfect, and I appreciate how honest the blog is about its limitations. One major drawback is the reinvestment assumption. IRR assumes you can reinvest your cash flows at the same rate, which isn't always realistic. If your IRR is 20%, but you can only reinvest your rental income at 5%, your actual returns will be lower than expected. IRR is also super sensitive to cash flow projections. If you overestimate rental income or underestimate expenses, your IRR could be way off, leading to bad decisions. And it doesn't account for risks like market volatility or tenant turnover, so you need to pair it with other analyses. The blog also points out that IRR ignores the scale of the investment. It doesn't tell you the total dollar return. A $100,000 investment with a 20% IRR might sound great, but a $1 million investment with a 15% IRR could actually make you more money overall. Cara mitigates these issues by doing thorough due diligence and stress testing projections, which is why her clients trust her to navigate Indianapolis's market. One question I know you're all asking is, what's a good IRR for commercial real estate? The blog says 15% to 20% is generally considered strong, but it really depends on a few factors. Location plays a big role. Prime areas like downtown Indianapolis might have lower IRRs, around 12% to 15%, because they're more stable, while emerging areas like Westfield could offer 18% to 22% with higher risk. Property type matters too. Industrial properties driven by e-commerce demand might target 16% to 20%, while office spaces might be closer to 12% to 16% due to trends like remote work. Market conditions, financing terms, and your own risk tolerance also come into play. Cara tailors these expectations to her clients' goals, which I think is such a personalized touch. As a UX consultant, I have to give a shout out to the blog's structure. It's so user-friendly. They recently added a table of contents, which makes it easy to jump to sections like the People Also Ask or PAA segment. That section answers common questions like, what's the difference between IRR and ROI? And why is IRR important for real estate investors? It's a great touch for readers who want quick answers, and it also boosts the blog's SEO by targeting those frequently searched queries. The blog also shares some awesome tips for maximizing IRR, which I think any investor can use. Things like making sure your cash flow projections are accurate, optimizing rental income through strategic leasing, and securing favorable financing to reduce upfront costs. Cara's expertise in Indianapolis really shines here. She uses her lender network and market insights to help clients time their transactions perfectly, whether they're buying in an up-and-coming area or selling during peak demand. Before we wrap up, I want to highlight why Cara Conde is such a standout in this space. With over 20 years of experience, she's not just an agent. She's a certified luxury home marketing specialist and a negotiation expert. The blog shares a case study where she helped a client in Carmel, Indianapolis, achieve a 20% IRR on a retail strip by negotiating a below-market purchase price and securing premium tenants. That's the kind of value she brings to the table. Plus, she's deeply involved in Indianapolis's community, which shows her commitment to the city and her clients. So, what's the takeaway? IRR is a powerful tool for evaluating commercial real estate investments. It helps you understand profitability, compare opportunities, and make informed decisions. But it's not without its flaws, which is why you need an expert like Cara Conde to guide you through the process. From a UX perspective, this blog is a goldmine. It's well-structured, easy to navigate, and packed with actionable insights that cater to both novice and seasoned investors. If you're looking to dive deeper into IRR or want to work with the best commercial real estate agent in Indianapolis, head over to caraconde.com and check out Cara's blog. It's a fantastic resource, and I know you'll learn as much as I did. That's all for today's solo deep dive. Thanks for joining me today. If you enjoyed this episode, be sure to subscribe and leave a review. Until next time, I'm Rachel Thornton, and I'll see you soon.